covered an overview glimpse. Okay. So when we speak about market approach, what is the method that comes into your mind? Market price could be one, right? And then comparable companies, right? So industry benchmarks and maybe some transaction multiples, right? So these are the methods prescribed under market approach broadly. Then when it comes to income approach, what all methods we use? Income approach, DCF, capitalization earning, and there could be also milestone based valuation. So under milestone based valuation, you can have an example of a life science company. For example, say first they make a design, and then they make a prototype, and then they conduct some animal trial, and then emergency human trials, and then they finally come to a stage where they can sell their product, apply for this FDA licenses, etc. And once they get an approved patent, then they can market their product, right? So it is like a journey of 6 to 7 years minimum investment from them, from where they can start generating revenue. So these are kind of milestone, because where you are completing stage 1, stage 2, stage 3, so how you can value it is also predetermined, because they also keep getting offers from some other companies that we are ready to acquire at this price. So intent letter is given. So based on some parameters, we can find out if there is some way to value such kinds of company, right? So this with income approach, and then once it comes to cost approach, in cost approach we have replacement method, and in replacement method, the thing is that in case it's a purely asset based company, then just also ensure that you are estimating the identify the asset. So the steps has been given over there. Identify the asset, estimate the replacement cost, and adjust for depreciation. So depreciation would be normally your accumulated depreciation till date, to understand how much tax benefit you have obtained till date. So that's your replacement cost. Then the next method is calibrating to the recent transaction, right? That is PORI method, I think. So that is also been discussed very deeply, but an overview to it. The price of recent investment is used as a reference point, and then it is calibrated further, ensuring value with proper valuation inputs. Okay, so these are based on various methods like market and income performance. So how income is performing, how market is performing. So based on that basis, we value these things. Then moving next, there could be mathematical models. So what is mathematical model? We will split into two parts. One is OPM and one is probability weighted expected return method. So when we speak about OPM, or option pricing method, it is more relevant with respect to Black-Scholes method and binomial methods. So these are like typically when EIF has invested into some portfolio companies and it has a complex capital structure, right? So let us share an example. Okay, I'll give you an example. So for example, the company, one of the CAT 3 or CAT 21 has invested in share warrants of a company. So the terms of share warrants is that today I am, so the price, current market price of the stock is 100 rupees. The terms is that today I can invest 25%. Okay, that is 25 rupees per share, and balance after 2 years. So balance means 75 rupees I have to invest after 2 years of time. Okay, so now this is an option available with me. So after 2 years I'll see if my prices is at what level. So in case it is beneficial to me, I would invest, otherwise I may even refrain from it, and I can directly go to the market and buy. Okay, so depending upon how much money I'm making, and so decision is dependent on certain future event. So over here, Black-Scholes comes into picture, or binomial. So that option needs to be valued, and valuer has to make a judgment how to take a call on this particular option, and accordingly give a recognition value to it, right? Then probability weighted expected return method. Now this method is actually, you can adopt 2 or 3 methods multiply and give a probability weighted average. So based on the judgment of the valuer. So it is more, valuation is an art and a science both. So here the judgmental role also comes into picture, and you have to decide what would be appropriate or ideal weights to be given depending upon the scenarios, depending upon the information that you have, depending upon the company, the strength, the size, the fund manager looks into it. So multiple ways. So it's more about judgment also, right? So these are broadly the methods which typically needs to be used while valuing the portfolios in an AIF, right? Now there could be certain scenarios. So one could be debt investment. In case you are valuing a debt, so generally debt is a component in the company. When you are valuing a company, debt is a component. So depends whether you have given them a loan, you have given them some debentures, so you are valuing it separately. So there is separate methods for it. Of course, it is income and market approach only, but then it is based on when you're calculating debt, you are using DCF method, you are just calculating the interest amount, and then principal amount, whatever is receivable at the end of the tenure, is being accordingly adjusted. So similarly, yield analysis, market approach, probability weighted scenarios, and asset-backed valuation is also possible. So when it comes to market approach, in that you can simply see, because some of the debts are also listed, some of the companies' debt are listed, government bonds are also listed, so you can always get a comparable value from the market also. So you have to look in a broader way that, okay, I have scenario 1, I have market price available, scenario 2, I also have income prices available with me. So maybe I can even take a weightage of both probability weighted scenarios, and I can even use that particular method. And sometimes it so happens that my debt is secured, okay, but my loan has been defaulted, my amount receivable is under stress. So in that case, if there is a security, maybe I can value the security to see how I can recover the amount, right? So these are like, various options available, how you can value the debt. Now, the next would be scenario analysis. Scenario analysis is more like similar to multiple options that is available to you to value an asset. So not necessarily that income and market approach is the only method. You have to be little bit open-minded in terms of understanding what all more information and updates is available with you, and based on certain scenarios you can identify and assign some values to it. So maybe you can even adopt 2-3 methods and give weight, as I previously mentioned. So steps in scenario analysis: identify the key scenario, assign the probabilities, estimate value for each scenario, and then calculate the weighted average. So scenario can also be like milestone basis, what we discussed, can also be based on exit value, that maybe some offers that I have received for an exit. Okay, so there could be multiple ways in which we can value, right? Then one important part comes over here is when it is listed, you are okay to still quote public market rate, but when it is unlisted and you're using a comparable method or even discounted method, so over there the problem comes in is adjusting to the marketability. So issues like DLOM is there, right? So there has to be certain more adjustments which is required to be made. So it could be discount on lack of marketability, adjustments for restrictions, and factors affecting the size of adjustments, right? So these are some broadly ways to look at it on your sorry, one second. Yes, I've covered. Okay. Okay, so these are basically adjustments for marketability and restrictions. So in short, in nutshell, it is you have to adopt to certain more principles to see that you are valuing the securities to far extent to at fair value. The next is important consideration, which is not much covered in the valuation part, but it is something unique which is being found in IPEV. We generally don't use in day-to-day scenario. It is ESG consideration. I'll give you an example. Okay, so how ESG can play a role in valuation. Today, normally by using all the methods, whether it is income, market method, any method, we are focused towards financial numbers. We are more focused towards financial numbers. But there are certain non-financial parameters also which influences the company, which is never taken care in any of the method. So that's why ESG comes into play. So this is more a kind of judgmental call that a valuer has to take. Again, judgmental means there has to be some backing to it, but how can it help you? So I'll just give you an example. Okay, I just came across a particular product. So normally when we drink tea, we drink in a paper cup. Okay, it's a cup made up of paper layered with wax. Now I'm just telling a story, huh? Don't treat it as a serial. Some stories can be real also, you can Google it later on. But this is something what I heard. This paper cup is coated with wax. This wax chemical is of two categories. One is good quality, one is little inferior quality. But still both the qualities somewhere affect some cells of our body, which as a study says that it is sometimes cancerous also to our body. So a startup comes up stating that I have something called seaweed. I am preparing something from a seaweed and it is totally a decomposable material and you can use it. So in a way you are saving papers, you are saving your body, you are doing something better to the society. So you are doing multiply each and everything, though it may be a little bit costly, it may be a little bit financially not very much viable, but a new innovation has definitely come. So because this has a component of saving environment, okay, it has gained a valuation in ESG. This type of company is getting funded at a very, very high valuation, which we cannot even imagine. And this is just at idea stage. So sometimes what happens, even you see some space tech companies are launching, saying that after 2 years we'll be launching our first rocket. The government has opened, apart from ISRO, they have opened space for private players to come into private and launch their own rockets and make this space exploration a better journey. So these kind of companies are getting valued. So there is something, support of government also in this particular sector. So in all, these kind of companies are getting valued at very, very high valuation. So the point is, not always the financial parameters will always play true in valuation, but sometimes ESG considerations is also should be taken into account. Now as a valuer, how do we evaluate it? So we simply have to study more about the company to understand what benefit they are giving, right? So we'll come to it, how more better we can explore it, but this just a glimpse I'm giving you that ESG consideration is something also that exists and we can implement in our thinking pattern for valuing any kind of company. Okay, so if we speak on the methodologies, so I have just adopted 5 type of categories of fund, which method may be suitable to use which method. Okay, so when it comes to venture capital method, we have option pricing method. It can be used, yes, it can be used. Probability weighted expected return method, yes. DCF, so venture capital companies can definitely use DCF, but on grounds, so it is allowed in IPV guidelines, but when we speak to certain venture capital companies, I think no one is interested to value company by DCF. They might look at the projections, they might like to study the business model in number terms. Okay, so they would like to see the financial model, but they would not rely much on funding a company by DCF method. So this is a very practical reality. Okay, so therefore it's not necessary that as a valuer also you can use the same method, but it's an option always available to you depending upon your judgment. Then market approach method, multiple method. So in VCs normally what happens, these are very early stage startup companies in which they invest into, and hence finding a very suitable competitors, because half of the companies are not revenue generating also, they are getting funded at idea stage. So in that scenario, if we don't have proper competitor, then probability is that even market approach may not give you a very correct number, but exceptions are always there, so sometimes it can be even used. NAV is not necessarily used. When it comes to replacement cost, again, because the investor's point of view is different, that investors thinking from future growth prospect, so that's why NAV method is also avoided, or replacement cost method is avoided. Income approach, which is capitalization of earning, can be used sometimes, but rarely. It is normally because, again, most of the early stage companies are in losses, so takes time to come into profits. Calibrating to recent transaction, I think very frequently this is the most common method used in valuing a portfolio in AIF. This is the most common method, subject to multiple calibration that is to be done, which is another study session, and which we already had actually earlier. Back testing is again what we studied in the previous session, but this is again applicable if there is a complex structure. So initially when you're investing, normally it is not a complex structure. Normally VCs or before VCs would be family friends would be investing. So technically there's not much documentation or much complex structure, so it is rarely used, but otherwise this is a common method in future to be used when it's coming to when these companies become big. The last is ESG consideration. So as I gave an example, even at idea stage, the company can be valued up to 1,000 crore rupees valuation also in such scenarios. So it do play a role definitely. So when it comes to private equity funds, so private equity is what? It's a company investing into large companies. So for example, a recent deal, it was there in Economic Times where ICICI Ventures had sold a stake in Theobrama. So Theobrama is considered to be a large company. So that deal is itself in some crores, so 1,000 crores. So that's why these kind of deals, how do you evaluate, is something a private equity guys does, right? So how do they look into certain scenarios? So this is again based on certain discussions with them. So they option pricing method. So over here, if it may or may not be used, I would say, but generally when a deal is already there in the portfolio, when they have already a deal or a company invested in a portfolio, they would prefer to go for some other method, but not immediately for OPM, because this is more when it is coming towards an exit, or they need to use the tool of call or put option into the company. So probability weighted expected return, yes, it can be used. DCF, again, as I said, P multiple is again more transaction based, so they look for better market multiple, and DCF is only used to look at the company, to understand the company in numbers term, but nothing more than that. So they may use multiples like EBITDA, sales multiple, etc. on the performance basis for tracking purpose, but not surely DCF may be used as a valuation tool for them. Then we have net asset value, which may be used if it is a very big company which is backed into assets. So replacement cost could be one of the example for it, right? And then income approach, we have capitalization of earning. It can be again used because normally such large companies are profit generating companies, and therefore we can use this method. So calibrating with recent transaction can also be used. Back testing can be used because as we studied in the previous one, there are complex structuring happening into the company, and we need to assign some values to it. So based on the liquidation preference and ESG consideration. So again, this could be important depending upon how they are performing into the market, right? So some examples of infrastructure funds. Anyone heard on infrastructure funds? So I can give an example. So there are some funds which invest into solar projects, right? So we can term that those because they invest into large solar projects also. So could be termed as an infrastructure fund. You have heard about it, right? Yes. Okay. So when you are valuing an infrastructure fund, you need to value a asset actually. Okay. So how do you value the asset? So again, you have market approach, income approach. So whatever approach suits you the best, you need to think, and based on that, you can take a call, right? The most common method used over here could be replacement or income generating methods, very commonly used, right? And when it comes to real estate funds, so any example on REIT? Have you heard REIT? Yes. Okay. Any example? Any company's name or something who has invested or who has issued REIT? Okay, I think multiple names. I heard Mindspace also. So I think there are Nexon also invest into malls and all. So multiple companies are there, I think. Yes, Nexus, correct. So in these categories, the income is more dependent on rental yield, right? So you can maybe discount your rental and then if the funds is valid for say 7 years of period, so at the 7th year, what is your estimated value uh, of the project that you can yield? So you can discount and get a value, right? That is one approach. Another approach is if I sell it today itself, what is my market value, right? And I can give a probability to both, right? So over here, calibrating to recent transaction may not be a very correct method, right? So that's how it works. And credit funds. So credit funds also, like it's a kind of debt which you have given, right? So it is investment into government bonds or some debentures of large companies. Okay, so these are some categories. And again, if as an AI, if you are valuing it, you can again discount the interest and principal what you are going to receive. But over here, you need to take into consideration credit rating agency report also, because category is important. In case it is under junk or default category, then appropriate call needs to be taken, or then you need to see if some asset is being mortgaged. So how can the portfolio or the AIF liquidate these amounts, right? So these are some commonly used methods. Now the next thing is, who can be the user for the valuation report? We are issuing a valuation report, but whom do you think this valuation report will be required? Who will be the users for this? Investor? Anyone else? Regulator? Correct. Anyone else? Auditor? Yes, absolutely right. Because when we make a balance sheet as on 31st March, we need to report the market value of investments. So of course the AIF would be making their own balance sheet, and they need to report. So auditors will also need this report to value the market value, right? Anyone else? Regulator said. Stakeholders. So stakeholders, I think the investors would be the main. Generally, these are not funded by debt, so I don't think so there would be any. Yes, absolutely right. Fund managers. So even fund managers need to know. So how does AIF work? There's always a carry, right? So when an investor is investing, there is all okay. How? I'll just come one step back. If you want to invest in an AIF, how do you invest? What are your criterias? Nothing related to valuation, but as a general knowledge thing. Okay. So in case you want to invest into an AIF, you need to invest minimum ₹1 crore is a condition, right? So normal it is said to be for instrument for HNI investors, right? So after that, sorry. Yes. Yes, so I think the exemption is given to angel investors who can invest up to 25 lakh rupees, and to the employees of those AIF organization who can invest up to 25 lakh rupees. So the minimum amount is less for them, right? And in this particular thing, in case, so like this is about investment. So once you make an investment, what are the terms and conditions into it? Typically, you would say there is a carry, there's a management fee, there's a carry. So management fees is somewhat similar to mutual funds, which is in range of 1 to 2%, okay, something like that. And the bigger, I mean, the size of the AUM, the lower could be the management fee probability. But when it comes to carry, so carry is something, it's a percentage of profit, what is being charged as a fees by the fund. So when we say percentage, for an example, I invested at 100 rupees, I am getting an exit at say 150 rupees. So 50 rupees is something the fund has made. There could be some more calculation, but for easy purpose, on 50 rupees, they charge a 20% carry fees. So on 50%, their fees is 20% on the profits. So which comes to say 10 rupees. So 10 rupees is something charged by the AIF, and of that component, it goes to the fund manager also, because fund manager has been evaluating your deals, and that's why he's been compensated for that additional amount for making good wise deals. So that's why fund manager is also important for them to have a look at the valuation report, so that they understand the performance and how much cut they will get, right? So overall, I think we covered investors, fund managers. Yeah, it is also to the trustee and the sponsors. It can be addressed to them also. Even they can evaluate and understand how better their fund managers are performing, and if any steps needs to be taken. So for fund managers also it is equally important, because they can make a sector-wise analysis also, or geographically analysis about, in case they've invested in a property, so which one is doing better or how. So I mean, all kind of analysis they can make to make further decisions, right? Okay, the next part is on frequency of valuation report, right? So you have learned to value by broad level methods, and you also understand the users of the report, okay, with the methods and all. Now, how frequently you need to issue the report is a question, right? So there's Cat 1, Cat 2, Cat 3 funds. It's been prescribed by SEBI in Alternative Investment Fund Regulation. The frequency is in Cat 1 AIF, it's once in 6 months, but if 75% of the investors have given consent, then you can go for annually. So generally what it does is, I think whenever they're signing an agreement with the investors, they do normally mention that we'll be providing once in a year. So technically it happens over there only, right? So they automatically get in consent. Same way for Cat 2 also, it is once in 6 months, and again annually, it can go annually if 75% of investors have given consent. But if it is Cat 3, then it is required every quarter, okay? And with additional reporting, that is in case because Cat 3 is a short-term horizon fund, as per understanding. So in case they need to report monthly NAV, so that they can timely give exit and entry to the investors. So in that case, what happens? They need many times monthly reporting. So many of the AI fund even go for monthly reporting instead of quarterly. So question is, normally I think Cat 3 funds normally invest in listed companies. They might be also into unlisted space, but the horizon is short term ideally, right? So for listed companies, normally they don't need to do a valuation report, or they need not obtain from a registered valuer. There can be an in-house team who does a valuation benchmarking, reports every day's value, and like every 30 days they need to submit to the SEBI about their NAV. But for unlisted shares, they depend on the registered values. So ideally it is to be given by us. Yes, please, sir. Calculation of leverage. Huh? Uh, so ideally that can be set internally, because what happens very rarely, I mean, these hedge funds actually have maximum exposure in equity only most of the time, okay, because it is short term, and they also want to invest into liquidable securities. So if there is a good amount of exit demand, so they can easily utilize the money. But many times some 5 to 10%, I would say an average, what I've been seeing, okay, they invest into unlisted securities, or maybe into some illiquid stocks, something like that. Derivative instruments can also be valued, right, on mark to market basis. So from valuation point of view, I'm not very clear on that part, but when it comes to valuation is what the exercise we need to do. But how they have to leverage exactly is a fund manager call. I mean, depending upon the theme that they're following, so based on that they follow or act upon. Okay. So Cat 3, it is normally it goes monthly also, right? Now, one challenge. So when you are appointed as a valuer of an AIF to value its portfolio companies, uh, so I'll put it this way, that when you are valuing a company, you can interact with the management, right? You can talk with them, you can understand the business, and you can take a call about their thought process, and they can explain you very well their projections, etc., on what assumptions they have made. But these all factors are absent when you are valuing portfolio companies of AIF, because you're not actually interacting with them, right? You're just interacting with the fund manager. So it's upon fund manager's view now how he can explain you the best, right? So that's why I think the most important thing over here is documentation. Your documentation is something very important. So like I've given you one challenge, can you identify some more challenges? That one challenge is that we cannot directly interact with the management of the company, so we cannot directly value the company. But since SEBI has mandated us that we need to value, so how can you, value these company? But there would be a lot of challenges. Can you tell some challenges? Correct. Very, very right. I think going concern is like one challenge for us to understand. We don't know whether the company is doing business or it's not doing, right? So since we don't know, we cannot interact with them. So we don't know. And you know what happens generally? Uh, this is with a cutoff as on 31st March. Okay. The company complete their filing of balance sheet, etc., complete their audit procedures, etc., by 30th September. Earlier, the due date prescribed by SEBI was also 30th September that you need to submit this report. You have to generate an NAV and submit to your investors. But the challenge is that how can you do it on 30th September itself when companies are, and we all know practically scenarios, very practical scenarios that balance sheets get completed till 31st October also. Till the time AOC 4 deadline doesn't hit, right? It goes up to that date. Another challenge is of course getting a balance sheet on timely basis to evaluate the financial performance of the company. Even getting provisional sometimes becomes a challenge. But again, to take a call on provisional note is a question. But then later SEBI extended this date permanently from 30th September to 31st October. This circular recently came on 2nd or 3rd October, this particular month before. So they permanently extended the deadline to 31st October. But again, the question remains, that is a valuation challenge to getting the data on time, right? So theoretically, if there are multiple companies in which the AIF is invested, especially like venture VC type of companies, PE companies, where they don't get data on time, and as a valuer you just get a month's time only to complete the entire exercise, benchmarking with so many companies, evaluating each and every company separately. There could be hundreds and 200, 300 companies in which they must have invested. So it becomes a challenge in doing in so much time bound duration. So this is a very big challenging exercise, right? So this is also one challenge. Apart from that, sometimes the startups are such, of course startups founders are famously saying that we don't have any competitors, we are the first and that's why we are a startup. But of course we know there are some competitors, we have to find in a broader way. But again the challenge is that if you are even going in a broader way, will it be correct to see these comparables are correct? Same way, if comparables are for real estate sector, I mean, sometimes it may happen that there is no deal in the surrounding area. So we might not get the correct value also. So these are some challenges. Then valuing early stage and high risk investment. So as we discussed, early stage are also pre-revenue stage type of companies. So valuing them again is a challenge, and it is difficult to find out correct competitor or some proper method to value them. It's a high risk investment. Then illiquid investment, so whether going concern is there or it is actually no going concern happening into the company, sometimes we don't even realize. So we have to even be, we rely on market news also. There was one case, for 2 consecutive years I was valuing one company, one fund. In that there was one particular company X. The company X, they invested in 2022. 2023 we got a deal that they have done a multiple of 7 times the last time investment. So say it was 100 crore valuation at March 22. So March 23 it went to 700 crore rupees. Okay. March 24 they vanished. They did not submit their financial statements. So we thought that surely this might be doing well. But as a standard research, we did little bit research on the company on public domain. We found there's some legal cases happening. Then through deal manager, we asked them to please connect to this company once and try to evaluate whether they are sending us some MIS or some performance indicator, whether the company is performing or not. And then after that call, all were in shock to realize that because of some legal tussle, there is 0 revenue in the current year. And then there was no option, but March 24, we had to write off the company entirely. So we don't come to know. I mean, interaction is very important and essential. So now it is only fund managers' attitude and behavior who can be cooperative and supportive to you and can help you to reach out to the companies to get the maximum data. Of course, it is better for them also to have all database ready so that they can also justify the investments that they've done to their sponsors, right? And then there are some complex capital structures. Yes, please. Correct. That's a very good question actually. What is a liability on the valuer? So valuer is purely giving on a judgmental basis. When we say judgmental basis means we have to be very specific in our report about some references, because in that case I got some reference in public domain, and then even the fund manager was able to communicate something with the company. So there was some communication happening and we kept those proof to justify that that is the reason we have given a zero value to it. Right. So we documentation is definitely very essential, but how does this risk whether someone is going to question valuers as of now? So as such, right now, the valuation report I believe is not required to be submitted to SEBI, but it is a document to be kept by the fund itself, and based on that they need to calculate NAV and give to the investors. So the NAV backing is definitely based on the valuers working. But when it comes to risk as of now, because this is very new domain, no past cases have happened till now, but documentation is a must. No option but to mention in the report. Hmm. Absolutely right. Yeah, so it may or may not be. So it depends on the lead investors also. Sometimes what happens, the fund does not have documents also. They just are dependent on the lead investor that, Mr. Daman is investing. He's a, DMart owner. He's investing means he must have applied his thought. So he says lead investor, he's assumed some 1,000 crore valuation. We are okay. We'll invest same. Even like companies which are good with ESG have a very high valuation. And sometimes they do take a risk of investing in such companies, maybe a small ticket size or whatever, but they go with the lead investors. So many times they don't even have the proper documentations available with them, except for SHA. It has happened in a couple of deals, and they said it's a very stellar deal and one-time deal. We couldn't speak much to the founders; they don't have time. So, but we wanted to get into this because of parallel good investors, and Mr. X person is joining, and then he can take this company to some X level. So why we should not, बहती गंगा में हाथ धो लो. Hmm. Okay, REIT valuation, what happens normally? Uh, it's fractional ownership of real estate property, right? So once you become a partner in an LLP, by LLP structure, they invest into um, these kinds of properties. So you're also actually a fractional ownership in this particular thing. From REIT, what does REIT do? REIT tries to value that particular property. Now, two ways to value. One is how much cash they have received till date, which they may want to pass on to the investors also to show that, we have been doing good and we have been generating return and giving back to you. And the other is the market value of it, that suppose someone wants to take an exit. But again, in that open-ended, close-ended type of fund is also there. So close-ended, ideally, they don't have to pay anything till the time of exit. As soon as they get exit, they will keep giving, and they would also want to give early to the investors so that they get better rate of return. The IRR improves, right, if they are able to deliver early without holding the funds by themselves. So they will be quick in that compliances and all those things. Now the thing is, when it comes from them, a valuation report comes. If it's a close-ended fund, they may not give a valuation report also, but they give you a working. I don't exactly recollect 64C, or we get some particular form from income tax under 194 LLB, 64C, right? Yeah. So they have to give a disclosure in that how much tax has been deducted, how much income you have to offer for tax if it is a pass-through income, or how much they've offered for tax and how much you need to offer in your particular income tax returns. So they give these all details to you, and based on that you need to file. So the calculation process over there is based on the receipts, because normally it's close-ended in real estate. And if it is open-ended, they are normally listed on stock exchange also. So like Mindspace REIT is listed. There's a couple of more. So they give you a price also, so you can even buy out from them. Right. Okay, then we have complex capital structure. So as I mentioned, one of the example of share warrant could apply over here. So you need to take a call on how to value it. Again, if it is going under some liquidation process, then liquidation preference, etc., needs to be considered, as was showcased in previous session, right? Market volatility. So these factors also like similar, like till the time there was uncertainty on US elections, the market was little volatile, and then suddenly once we came to know that Trump has won, the cryptocurrency has gained market momentum. So actually those won. So you have to consider the factors also. What market volatility swing would lead to certain asset, right? And then you have distressed asset and insolvency. So again, there was one company X, it was into edtech sector. Suddenly, after 6 months of fundraising, went into liquidation. So there was no, during liquidation, you know, the founders are most deactivated person. We can't even trace them. Neither the communications are, in fact, the emails also get bounced. So there's no, I mean, very difficult to find out. It's just public sources from where we can get. Luckily for one of the person in my known was doing some insolvency proceedings. And I just learned from him, oh, it's the same company which I'm trying to value over here. And it has gone under insolvency. So we don't come to know also many times. So again, then when I researched about the company, I got into public domain, some news, I got it. But from there I was able to fetch, yes, okay, this company is under liquidation and we need to write it off. Right. So regularity and legal uncertainty. So again, suddenly government may promote certain sector and suddenly it may, like I think in the previous session was showcased that two-wheelers in Maharashtra, Uber two-wheelers, etc. were banned. So, and sometimes suddenly they will promote certain places like food park. If you set up a food park, you get a subsidy. So sometimes government starts promoting certain sector, manufacturing sector, could be any sector, but that's how it works. And then high illiquidity premium for private investment, kind of unjustifiable premium. So these are some challenges. We also don't come to know sometimes that how can you give a company 100 crore valuation without zero revenue, like a practical scenario. So lot of challenges in these segments. Okay. So if we speak about that today you get an engagement that you need to do an AIF valuation. Okay, you have to do a portfolio company's valuation in an AIF. So according to your understanding about the session, what all things data you will need to ask, because you cannot interact with the client, client in the sense the management of the company. So what all things or what all data you think you will need to gather, just a normal discussion I mean. Probably this would be the second last slide. Actually last slide, but we are just discussing now. So what all data you can ask? Investment documents, so maybe shareholder agreements, MIS, pitch deck, provisional financial statements. Pitch deck would give you an idea what the company is into, which sector. Projections of the company, previously done valuation round or valuation report available, right? These are some common documents which you will ask. So based on that, you will gather all the data. You can also ask for ESOP policy in case it is something provisioned into shareholder agreement. You can even ask for cap table, right? And once you have these data, then you will have to ask even for fund managers evaluation report, how they have evaluated this deal, how they have come out with this valuation, whether they have given some multiple, what is the thought process when they thought this valuation is good. So ideally, based on that, once you gather all this information, then you're evaluating a company in detail. And then of course, importantly, public domain, where you have to research about it in detail, about what are the facts available about this company, right? So these are some basic documents which you need to have. And when you are making a valuation report, what all things you need to cover? So when you are making a valuation report of an AIF, some important aspect, because actually speaking, SEBI has not prescribed any format, or there is no specific format actually designed by anyone in terms of AIF, valuation of portfolio companies. But as such, I just made a general checklist that these all things should be at least covered, and then depending upon time, how more better you can go, how more team members you can deploy and make it more better is your choice, depending upon the engagement terms with the fund house. So one is you're giving a covering letter, making them understand under which all sections you are issuing the report. Then you're making an executive summary about the background of the fund, right? You're talking about the terms of the engagement, what is the purpose of doing valuation, and the methodologies that you're using. So we have been following IPV guidelines, so we have to mention something about that also. Needless to say, caveat or disclaimer is the most important part that needs to be covered. And after that, you need to declare your independence. So there were some 3 conditions. So it is better if you give a declaration in the report itself, though even you can give an engagement letter or in valuation report, but somewhere it is to be given that you are independent to accept this assignment with 3 years of experience, and you're also having a degree of IBBI with C or CS or cost accountant or CFA degree. And then in a summarized way, you have to give a valuation of the companies. So it could be companies, it could be properties, it could be bonds, whatever. So you have to give in a summarized way what is a cost, what is a fair market value, which you have computed. And once you get the total, that becomes your value of your AIF, actually speaking, in terms of asset. So these are broadly the things, but the important part is annexures. For annexures, we have been following a practice of giving 1-pager report, or 1-pager valuation report for each and every company or security. So if a startup has invested into say 100 companies, so we're making 100-page annexure. For each and every company, we're giving them a short background in which sector they are working into, right? And what is their source of source of information we have gathered, if there is any public announcement happened, so a disclosure or a link for it. So these all things we cover. Apart from that, the cost and the fair market value of the investment, and the method used. So method used with a justification that we have been using this method because of so and so reason, in case we are giving some weights to it. So all this justification needs to be given in detail. So should not be just 3-4 page report, but should be a very detailed report, should carve out all these things. So these are standards which is being followed right now in the market, in the industry. So maybe it can be a takeaway from you for today's session, that in case you're doing this, please include all the annexures also. There are some people who are not putting it, so we should be in a best professional practice maybe, right? So with this, I would just like to end with a quote. The valuations may vary, but values are forever. Thank you.
Thank you, Mr. Nishant Soni. It was, I think, very insightful, and people have enjoyed, because you have given a practical challenges for where the valuations, how to value on AIFs, what are the practical challenges CAs are facing for their clients, and I think it was very fruitful for them. Please give him a round of applause. Thank you. So with this, we come to an end to the session. For all the PPTs I are requesting for, it will be available on the website soon. Probably it takes 7 to 8 days to get uploaded. Thank you.